Okay.
All right.
Good evening, everyone. Yeah, all good. Good evening, everyone. Cool. Thanks for being here. I'll just do a quick introduction. We've got Michael Roger, the founder of PropHero. He's an ex-McKinsey consultant, very big in data analytics and artificial intelligence. He used to head their AI practice, and he is now, he'll tell you more about PropHero himself, so I would do that. And we also have Pablo Gil Presua, who's his co-founder partner, and Pablo's a serial entrepreneur who's very tech savvy, and he takes care of half of the operations of PropHero as well. So I'll leave it to these guys. Please, once again, mute yourself, put your cameras on. Whatever questions you have, let's put them in the chat box. Once the presentation is over, we'll open the floor, and Michael and Pablo can take all the questions. Thank you. Over to you, Michael.
All right. Thanks a lot, Suvidh. Can you go on mute, please? Siam, could you go on mute, please? All right. I don't think Siam listens. Oh, thank you, Siam. All right. Hi, everyone. My name is Michael Roger. I'm the co-founder of PropHero, and I'm here with my colleague, Pablo. Well, this session is really about you guys, and really about well, telling you a little bit about how you can use data to make property investments. So let's get started. Before we start, just the usual disclaimer, right? So this presentation does not constitute financial and investment advice. It is not and does not intend to replace other sources of independent advice, which are always recommended when you seek where appropriate. All right. This being said, a few things we will cover during this session, guys. First, we'll do like a super quick intro about ourselves. Then we'll tell you. Pooja, could you go on mute, please?
I don't know.
Pooja, Ronak, Santosh, can you all please go on mute? Thank you.
Thank you. All right, so we'll just give you like a quick market update with an international perspective. Then we'll discuss about what makes a great investment property from a data perspective, right? And then we'll finish the conversation with just like common pitfalls that we see all the time. And finally, we'll do our Q&A. All right. So quick intro. So as I was saying, my name is Michael Roger. I'm the co-founder of head of data at PropHero. Before that, I was working at McKinsey, where I was leading the data and artificial practice. Before that, I was in Europe, where I was in investment banking. And yeah, and here is my co-founder, Pablo.
Yeah, so a bit about myself. I'm a serial entrepreneur, my previous business.
Raul, could you go on mute, please?
I think we can do it as the host. You may be able to do this as the host.
Yeah.
And yeah, my previous business, we managed to make it global, over 200 employees. And on the side, I've always been a property investor as well, like with over 10 investment properties, which has been, I mean, very well up until now. And as everyone here, I assume we are all passionate about property investment. And that's how when Michael came to me with these amazing data models, I was, okay, he came to me, Paulo, this is not for you to continue investing, but for you to, for us to build an amazing business out of this. So this is a bit of, long story short, how we came together.
All right. So what's the story behind our company, guys? So as Pablo was saying, we've both been investing in property for many, many years. And I remember like when I was doing my first investment property in Australia, I was already in the artificial intelligence world at the time. And I was struck to see the difference between the amazing thing I was doing at my work on data and the, well, kind of like gut feeling, finger in the air that I was seeing in the industry, right? To be very transparent, I myself hired buyer's agents to invest in property. And yeah, like I could see that many people in the industry rely on gut feeling on what they can read on real estate or domain or in the press. They just buy where they live. And of course, well, that's just like not the most efficient, right? So that's kind of like how we came up with the idea of PropHero, which is the next generation buyer's agency. And our mission is really to make property investment simple, transparent, and more profitable through technology. And well, through this presentation, we hope that we'll all get you excited about data and yourself finding the insights that will help you make better investments. So very quickly, so we are all about data. We're a one-stop shop, which means that we do everything for our clients end to end, from defining the strategy to managing the property. And also, well, we are accompanying our clients end to end, right, through our dedicated coaches. I was told that I can actually mute everyone. Let me try to do this here.
I think it will be one by one, maybe.
It's one by one. All right. Well, so let's just move on then. All right. So this presentation will be about data, guys. Just for you to know, we have more than 10 million data points. We track the entire market all the time. We look at over 200 features to understand what makes a great investment property. And the idea through this presentation is to give you some insights on what to look for. Some of the things that we look at are pretty straightforward, like demand, like distance to train station, vacancy rate, lifestyle, etc., or supply, like zoning or land available, or even macroeconomics. Some are a little bit more tricky. So during this next hour and a half, we'll go into some of these insights to help you with your next investments.
And also a note on this one is like for you to realize, and it was my realization. I know that I'm an engineer of background, but I'm not a data guy. And it was like to analyze all these things on a one by one, it's impossible. And then it's when you have the system running continuously that you manage to get a lot of insights, very good insights.
Yeah, exactly. So let's start by learning a little bit about you guys. So could you please all take your phone and go to paulev.com/PropHeroInvest581. So you have the address at the top of my slide here, paulev.com/PropHeroInvest581. All right, and please, so you can answer several questions at the time. And yeah, and the idea is just to learn a little bit about you. So paulev.com/PropHeroInvest581.
I think they are waiting because they
Yeah.
start to reply.
एक मिनट यार सारे
Anuj, can you mute yourself, please?
Okay, I think we have quite a few.
All right, yeah, so we've got quite a few responses. Okay, so quite a diverse group here. Only, 20% of you own more than 2 investment properties.
That's more than Australian average.
That's more than Australian average, indeed. All right.
Okay.
Cool, guys. Well, indeed, a very diverse group that we have here. Don't close this page. We will have a few other questions for you later on during this presentation. All right, so let's us give you a market update. And I think someone wrote on the pages. I'm not sure how you did that, guys. I don't know if you can erase it.
It's weird.
Yeah. Whoever wrote on the, could you, Suraj, could you erase these nice drawings? All right, so let's talk about macroeconomic outlook. I'm sure you see all the time news about the Australian economy. So I thought what would be more interesting is to compare what's happening in Australia with what's happening around the globe. And we're actually in a quite unique situation here, which is that actually we are one of the few countries which has fully recovered from the pandemic, from an economic impact. And to be very precise, we are one of the few countries where the GDP is higher than before the pandemic, right? So this is actually quite impressive for Australia. And when we look at unemployment rate, we are below historical average, which is quite impressive. So, you know, like, well, I think, well, being Australian myself, I know that I like to complain about this beautiful country, but actually, well, we did pretty well compared to international players. When we look beyond the pandemic and for the next 20 years, there is one thing that is even more unique about Australia, which is its population growth. As many of you would know, there is a correlation between a growth in population and a growth in property prices. And actually, Australia is one of the countries with the highest expected population growth for the next 20 years, right? And of course, well, that is a good indicator of what the property market could be in the future, right? If you take Europe, for example, population is decreasing, which means that in many areas, vacancy rates are going to increase quite substantially over the coming years, right? And as we will see later on during this presentation, vacancy is one of the indicators of price growth or price decrease. So I'm going to share that with you guys. I don't think many people talk about this, but actually, yes, it's quite unique about Australia, and we should all know that as we are making property investments. Speaking of property investments, so I'm sure all of you guys have read in the news that property prices went up quite drastically over the past 2 years. What's funny, by the way, is that actually, well, most economists were not expecting this about a year and a half ago, right? But this happened, right, with prices for established houses going 32% on average in Sydney, 29 in Canberra, 21 in Brisbane, 14 in Perth. I mean, that's a lot, right? But I don't think that's what's interesting. What's interesting is this. On this graph, what you see, guys, is, so each point is a suburb. In the x-axis, you have the price growth over the past 2 years, and in the y-axis, you have the rental yield. So in a very simple way, if you're in the top right, you're in a high growth and high yield area. If you're bottom left, you're in negative growth and low yield area. And what's interesting is that even though prices went up quite significantly on average over the past 2 years, what you saw in the previous page, actually it's very uneven across the country. You have many suburbs that you can see on the left where prices actually went down. You also have suburbs, which you can see at the bottom of this graph, where, well, prices went up a little bit, but cash flows are negative. And only a tiny minority of suburbs saw both high capital growth and high yield, right? And actually, that's to say that, yes, the market is going very well on average, but when you deep dive on a local area level, actually, it's very uneven, which means that for you guys, it's even more pressure to find the right areas and the right types of properties. Another thing that is interesting is that population has moved over the past 2 years. What you can see here is, again, for different suburbs, the vacancy rates and how the vacancy rate evolved over the past 2 years. And what you can see on the top right is that many suburbs, in particular in Victoria and New South Wales, saw a significant increase in vacancy, right? Whereas others actually saw a very low vacancy rate, and we will see later on what's the impact on property prices. Yes, Suraj, I think you asked a question. Curious as to why South Australia, Tasmania, and ACT are not on this chart. That's a good point. Oh, sorry, that's Rahul. Yes, so that's a good point. It was just because I tried to show you some insights, and it was just a little bit messy with many more states. However, if you're interested, I mean, of course, we've got all the data. I'm very happy to send you what it looks like for these 3 states. So just reach out to us, Rahul, info@prophero.com.au, and I'll just share it with you. But just for this presentation, it was just a bit messy. All good? All right. So now that we've talked about that, yes, market is going up, but in a very uneven way, and with population moving quite drastically from one area to the other, let's look at what makes a great property investment. So I'm sure this will be pretty obvious to some of you guys, but maybe not for everyone. So I'll still spend a little bit of time. So typically what you would want when you invest in property is to have capital growth and cash flows. And from a financial perspective, it's actually the actualized value of your capital gains and your cash flows that gives you the full profitability of your investment. So we try to make it very simple for you guys. So you can look when you're going to make your next investments, ask yourself 8 questions, right? Number 1, is this an area with strong demand and low supply risk, right? So do we think that there will be like many jobs created? Is the vacancy rate low? Is there a risk of new builds, etc.? Number 2 is, am I paying the market price, under price, or above the price? We are seeing, especially right now, all the time, people are in the fear of missing out and pay, honestly, very stupid prices, right? And so that's just like not good. So really do your due diligence to understand what's the fair market price for the property. Number 3, is there improvement potential for this property? Right? So can you add an extra bedroom or a granny flat? Can you add a garage? Can you add a shed? Can you do a light reno? And think that even if you don't want to do it, someone may the day that you want to sell. So the potential to make an improvement has value, right? Number 4 is red flags. By red flags, think about flood risk, bushfire risk, noise risk, new development risks. These red flags, many people don't care about them when the market is up. So you can sell pretty much anything when the market is going up. However, these properties are extremely hard to sell during downtimes, and this is where we see the biggest drops in value. So again, do your due diligence. There are like publicly available data sources to do these checks, so make sure you do them. That's for capital growth. For cash flows, what we want is, well, of course, high rental yields, right? That will allow you to pay back your mortgage and pay your rental expenses, etc. Growing rents, that's something that people often overlook, but actually, between 2 areas that have comparable yields, there will be an immense difference between the one where rents go up a lot and where rents are flat. And you see big differences in this variable across regions. 7, of course, low expenses. This, I would say, of course, will depend on the type of investment that you make. It may be absolutely fine to buy a very old property if you factor in that you will have to do some renovation or maintenance over time. And finally, low vacancy, right? Of course, a high vacancy rate, and we will see that later on, has a massive impact on your overall profitability. Let me check the question that we have on the chat right now.
I think we can discuss about all of them later on.
Let's discuss about them later on. Yeah. All right. So, as promised, guys, we wanted to show you a few interesting insights from our data model, right? So, as I was saying, we look at hundreds of data points, so we had to choose. We chose 3. A caveat, though, there is no silver bullet when it comes to data for property. So, actually, our model takes hundreds of variables, because it takes hundreds of variables to have a good opinion about what's good and what's bad. So we're only going to look at 3. So please don't take this as these 3 as silver bullets on where to invest, because you could make like big mistakes. All right. All right. First of all, please take your phone again, paulev.com/PropHeroInvest581, and please enter which indicators or variables or things that you look at when you invest in property. So same address, paulev.com/PropHeroInvest581. some trends here. It feels like what you're the most looking at is capital growth, land size, yield, schools, the public schools, transport, shopping, what else? Vacancy, cash flows. Interesting. What I think is great, guys, is that you can see here that all of you came up with, I think, maybe 30, 40 different indicators. And I think, well, then you are all aware that, yes, indeed, it takes a lot of analysis to find the right area and the right property. Yeah, I see location, developments, redevelopments, shopping, demographics, train station. Great. Well, that's great, guys. That's, yeah. So indeed, that's there are a lot of things to look at. And one thing though is that though rental yield may not be the hardest to compute by yourself, on capital growth, this is where actually you will find the biggest variations, because most of you, I would assume, well, relies on past data to form opinions. So let's look at a few insights from our models. Would you mind going on mute, please? Thank you. All right. So insight number one. What you see here is the impact that vacancy rate 2 years ago had on prices over the past 2 years. And what you can see is that suburbs with a vacancy rate below 1% were twice more likely to experience high growth than the other suburbs. And well, I think that when we computed in our model, just to give you an idea, right? Actually, 1% is one of these biggest correlation. Suraj, would you mind going on mute? And so what I would like to say, guys, is that as we were saying before, vacancy is indeed an important indicator. However, as mentioned again before, it's not a silver bullet. And as you can see, some suburbs which had a very high vacancy rates 2 years ago still did well, right? But I think that no silver bullet, but for you, whenever you're going to make your next investments, please look at vacancy and also look at the trend in vacancy, right? It's not in this graph here, but what we saw as well is that actually decreasing vacancy is also a good indicator of high capital growth, all right? All right, insight number two. This one, I think, may be counterintuitive given what you read given what you may read in the news. What we keep reading is that Australians moved to regional areas and that the CBDs are dead and that you should invest in regional areas, etc. This graph, I would like to say first, only shows Brisbane because it actually doesn't really make sense to show different cities in this single graph. What we saw is that over the past 4 years, on average, the closer you were to the city, the higher your capital gains, right? Now, again, it's not a silver bullet. And actually, this morning, with Pablo, we bought 2 properties near Brisbane, actually 30 kilometers from Brisbane, right? So even though this graph shows you that on average, capital gains were higher, closer to the city, actually you can still find good buckets a bit further out. I think here for you, the main insight is if you are going to invest very far from a city, be even more cautious, right? Because statistically, right, more will experience low growth. So again, no silver bullets, but if you want to invest very far from a city, please be even more cautious, right? Especially if the vacancy rate is high or increasing. Insight number 3. There is a positive correlation between suburb affluence and price growth. What we looked at is a suburb affluence 5 years ago and what prices did over the past 5 years. And here again, affluent suburbs were 2.6 times more likely to experience high growth than less affluent ones. Now, there is something I think even more interesting that we see in our data is that if you want to perform even better, what's great is to find suburbs that are getting gentrified. So suburbs that are becoming affluent. In 9 months, guys, we will receive the results from the new census, from the 2021 census. And it will be extremely interesting to see where population is getting more affluent. And so if you invest 9 months from now, please just check the census data and check if in the suburb you want to invest in, if the average income went up, went down, or remained flat, right? Again, no silver bullets. I'm just showing you like actual data. But yeah, look for signs of affluence. This could increase your likelihood to make the right choice. So as you've seen, right, we've seen only three indicators so far. But well, you can still have some learning, right? Number one, be careful if vacancy rate is well above 1% and or increasing. Be careful if you're investing very far from the CBD. And also try to look for areas where the population is getting more affluent. Again, as you have seen in these graphs, right, no silver bullets. There are exceptions, there are outliers. You could invest in an area with a low vacancy, rich people, and close to the city and still underperform. But these are just like 3 signs that you could look into for your next investment. Now, let's, well, find out together, let's analyze a few properties together. Well, and let us show you like type of properties that we have bought recently and why we bought them. So this property in South Queensland, $500,000, dollars, 670 square meters, 4.7 rental yield, historical price growth of 2.9% per annum. I cannot show you what our model was expecting. Monthly cash flows of plus $370, vacancy rate of 0.6% and decreasing, and suburb located in an area with a growing population, growing economy, and almost no land available. So let's look at our rule of 8. And after, guys, please pay attention because we will do this together for another property right after. So point number 1, strong demand and low supply risk. Yes, as I was saying before, it's an area where the population is growing, where the economy is growing, there is no land available for development, and zoning does not allow to build new buildings. Okay, so number 1 is ticked. And of course, I'm simplifying the analysis, right? Under market price. Yes, so this I didn't mention. Actually, well, on this property, we're able to buy it above 20,000 below what comparable properties were selling for. Improvement potential, yes, big lands and the possibility as per council rules to add a 4th bedroom or a granny flat and also to add a shed. Little caveat, guys, in some areas around Australia, having a shed, if you don't have a shed and you can, actually the return on investment or just putting a shed in your garden is pretty high. So just for you to know, especially if you live in areas where that are really affluent, actually this can have a very good return on investment. No red flag. Okay, so this was no noise, no fire, no flood, etc. Good neighborhood. High rental yield, yes. And here I would say, I'm sure you see all the time people investing with yield of like 6, 7, 8%. I would just say, and as per our data, watch out. When you're getting a yield is extremely high, you may indeed make the best deal in the world, but you may also buy in an area where prices are not increasing or even decreasing, and that's why the yield is high, right? So just be careful here. At 4.7% for this location, for this type of investment, we are extremely happy. Growing rent, yes, plus 2.9% per year. Low expenses, yes, it was a good condition brick house. We inspected the property, there was nothing wrong with it. And finally, low vacancy, yes, 0.6. So this property, in a very high level, passed all our 8 tests. And again, I'm saying like a high level. And so we actually bought it for one of our clients. All right, now is your turn, guys. So we are going to do the same together, but for this property. South Queensland, same price, $500,000, 360 square meter of land, 3.5% rental yield, rent going at 1.9% per year, monthly cash flow actually negative, vacancy of 0.9%, and also located in a new suburb, right? So where actually you have like many houses that are new builds, and also it actually happens to be in a bushfire risk area. So you know the drill. paulev.com/PropHero invest 581. All right, and here what I would like you to do, guys, is to click on the conditions that are met, right? So please click on what you think is good and what you think is not. So, and just to clarify, you click where you think it's fine. Don't click if you think there is a problem with the property. Okay. Let's give you a few more seconds. So let's review this together. Thank you for your responses here. All right. So strong demand and low supply risk. Well, actually, this is a brand new area, new build all the time, and actually like quite a strong risk on supply. Now, to be perfectly transparent, it's also an area where the population is growing. So actually, it's not a complete red flag, but well, you just prefer to, if you have the choice, to invest in an area where you wouldn't see that. Under market price. So for this type of new builds, you actually often pay the normal price because all the houses are the same. You would actually pay the same as the labor. So it's actually like harder to find great deals when all the houses look the same. So you're not making a bad deal, but just not a great deal. Improvement potential, not really, right? The house is relatively new. There is no land, so you cannot build anything. So not really any improvement potential. No red flag, as I was saying, it's actually in a bushfire risk area. And on these guys, you have many, as I was saying, you have many publicly available data sources. So it's actually pretty easy for you to find out if there is a risk or not. High rental yield, no, 3.5%. So in South Queensland, you can get, in this area, you can get much better. And then growing rents, low expenses and low vacancy actually were fine. Right, rents indeed are growing in the area. It's kind of like a new build where you would not expect on average high expenses and very low vacancy. So that actually is fine. So all in all, as you will see, and you can reuse this framework for your next investment, guys, we didn't go with it, obviously. So I hope this was clear. And by the way, guys, if you have more questions, just feel free to reach out to us, right? I mean, this is, of course, very high level, but again, like feel free to ask us any question during the Q&A or after the session. All right. So if we compare just like these two properties, again, that are not too far apart, same price, different rental yield, different capital growth, different rental expenses, and when you look at cash flows, well, actually quite a big difference. When you look at capital gain, and here I just want to say that it's looking at past performance, not forward looking. Big difference here. And when you look at the total profit over 10 years, the one on the left gets 4 times more, right? So even though they are same price, 3-bedroom, not very far from each other, 4x difference in terms of total return or total profit for the one on the left, right? So please, when you make your next investment, think of these like 8 parameters. Think about this due diligence and just well, try to minimize your risk. All right. So before we move on to the Q&As, just wanted to share some like very honest things we see all the time, and that really make us sad. So yeah, so just see it as like a friendly advice, you know, like whether you go with a buyer's agent or by yourself, please just avoid. Number one is fear of missing out. On this one, honestly, especially now, we see it all the time. People get excited, they get pushed by the seller's agents, and they put really stupid prices on properties. So please, for an investment, remove your emotions, right? And just use your brain, right? Rely on your analysis, right? And don't listen to any push from the seller's agents or your friend or whatever. No, just like be rational in your investments. And so no fear of missing out. And again, don't buy a property because it looks nice, right? Buy a property because you think it makes sense from an investment perspective. So emotions is the enemy of a good investment, right? Yes, you can be lucky, but don't buy with your emotions.
And actually on this one, it's a very different thing to buy as an owner-occupied than to buy as an investment. That's why as an investment, you're not going to put the emotions. And it's, I mean, a great difference.
And that's actually true. You know, like many people buy an investment property like they would buy their own house. And that's typically a very big mistake, right? It's just like not the same thing, right? Don't buy a house because you would want to live in it, right? Buy a house because it makes sense from a financial perspective. Number 3, be careful with off the plan. I see so many people fall into traps with this. Of course, some are good. Some people have made like great returns on off the plan. I'm just saying, be careful, right? There are a lot of like dodgy players in the industry. And so please, if you want to go this route, and there are some very good deals indeed, be extra careful. Number 4, be careful with your cash flows. Again, we see it so often, right? People buy in an area with like a 3.5% yield, sometimes even lower. Well, it's absolutely fine if you have a very good salary and if you're really convinced that the capital gain will be worth it, right? But if you're limited on cash, remember that negative cash flows will prevent you from being able to invest more, right? So if you find a property, you want to buy it, check your cash flows, right? You can find calculators everywhere online. Calculate your cash flows and think, will this prevent me from buying the next one, right? And again, some properties have negative cash flows, but are amazing deals because of the capital gains, right? But it's just like not for everyone. Number 5, and I think we repeated that quite a few times during this call, lack of due diligence. Again, we see it all the time, right? We see people buy in flooding areas. We see people buying in bushfire areas. We see people buying next to a highway, right? It's fine when the market is high, you know, like anyone buys anything. When the market is down, it's really hard to sell, right? So please do your due diligence, right? Check that, remember the rule of 8, check every of these 8 items to reduce the risk of making a bad investment. Finally, I know that this was a question that actually it's a question that we hear. It's a question that we hear very often, right? And sorry, let's just unmute Madi. Can you mute Madi? And so on this one, I was saying you have like very good deals on off the plan, but you also have very bad ones. And just if you want to go this route, so just for you to know, 52% of the plan units at settlements have a lower valuation at settlements than when they signed the contract. And this is due to developers or intermediaries getting their commissions, is due to the location not being great with like lots of supply, is due to like a small land, is due to like negative cash flows, is due to like uncertainty on completion. So again, like I've seen so many people go down this route, some making great deals, some very bad. Please just be extra careful. So to summarize, before we move on to the Q&As, so when you invest in property, think both capital gains and cash flows. Feel free to reuse our rule of 8 and some of the tips that we have given you that we got from our data models. And second thing is within this rule of 8, be extra careful on the due diligence, right? And again, like if you want to see more of this data or more details on this analysis, please just reach out info@propHero.com.au. All right, questions?
Yeah, I'm actually better than a question because on the chat I was going basically shopping at the same time. So
all right,
if you want, we can go one by one and then.
Yes. So. All right, let me. All right, so I saw the ones for asking for different states, and guys, just reach out to us. I'm very happy to show this graph for other states. So, question: what is the point of having a buyer's agent, considering property prices always go up here in Australia? Well, actually, Bomik, as you have seen at the beginning of this presentation, there is a huge difference in performance between suburbs, and even within a suburb, within streets, and even within streets, within types of properties, right? A 2-bedroom unit here will perform extremely different from a 3-bedroom house there. So the point of having a buyer's agent, I think, well, and of course, I'm a little bit biased here, but I think that, I mean, the reason why we launched PropHero is to help people reduce their risk and just try to make better investments. So I would say, I mean, if you are extremely deep in property, if everything that I have said covered today is absolutely obvious because you've made the analysis yourself, then of course, yeah, like there is less value. But if you don't have the time, or if you are not that deep into this data, these insights, then well, I think there is some value.
About me, there is a great difference. I mean, I agree. Like, I mean, it looks as if everything in Australia grows, but there's a very big difference between a good and a great investment. I mean, yeah, you can do an investment that will grow, give you a good yield, decent yield, but the combination of that makes a great investment, it's a whole difference.
Yeah. Next question was from, and by the way, feel free to unmute and ask us if we don't really answer your question, right? So Bomik, for example, like feel free to ask us if the answer is not clear.
Yep, all good. Thanks.
Next question was from Vinay. How are COVID impacts fed into your machine learning models, and how has it impacted property in general? So, two things here. So, from without going too much into the technical aspects, what we look for is overperformance. So, actually, we don't track what's happening in the Australian economy. We track what is comparatively the best suburb to invest in. So it's a little bit technical, but that's actually what we look for is the best suburb. But of course, if all of Australia goes down, potentially we will go down as well. To your point on COVID impact, what we saw was the most interesting was the, okay, I'll try to make it simple, the volatility and the heterogeneity, so like the unevenness of performance. In a simplified way, all of Australia, okay, it's ultra simplified, but Australia used on average to go up, right? And in many areas, that was just the case. What we are seeing with COVID is that the volatility in performance increased. So like the speed and the acceleration at which prices and yields change actually increased. So actually, it's a much more unstable market today than it was before COVID. And the spread, so the difference in performance between areas increased. So in short, you have big winners, but also big losers, right? And this even in a simplified way, even more than before COVID. And this was clear. In another point, I think we covered it earlier during this presentation, but we really saw movements in the population. And as we were saying before, there is some correlation between vacancy and prices. And we really saw areas where people were just leaving, either leaving the country or leaving to other suburbs. And the property prices in those areas like went down significantly. So I would say that to your point, Vinay, like what you can take away from this presentation today. So for COVID right now, think about like what makes it a big winner versus a big loser, and what is the expectations or what is the recent trend in vacancy, right? Just by looking at the trend in vacancy, you can get a sense if people actually want to live there or not. And please, Vinay, tell me if that's clear or not. All right, I move on to the next one from Srikar. Thanks, Srikar, from asking a question. So, what's the best combination of scenarios to consider? First home or second rental property? So, we have an article on our website, and I'll be happy if you send me an email, Srikar, to forward you this article. So, as I think you've understood, so we are all about data, right? And from a financial perspective, so if you remove the emotional aspect, it is statistically unlikely that where you live is the best area in the country to invest, right? Statistically, it's actually like unlikely. So from a financial perspective, it is unlikely that making an investment where you live is as profitable as making another investment. Now, of course, there are tax benefits that you should discuss with your accountant or financial advisor, which kind of like reduces the gap between investing in an average area where you live and investing in an area just as an investment. So I would say my answer to you is not really an answer, is it depends. If you live in an area that you really believe in terms of capital growth and in terms of like rental yield, so just check your rent today and how much you could buy your property, it may make sense. If you live in an area where prices go down or where yield is extremely low, then you may want to consider your second option. But that's, of course, from a mathematical, like financial perspective, like if your emotions want to get your first home, just of course go for it.
Srikar, a note on that one, and I've heard it like from a lot of contacts, relatives, that it's very difficult to buy a home to live in because of the emotional aspect, and probably because the place where you want to live in is already more expensive than what makes a good rental yield. So I've heard it from a lot of people wanting to invest on a home to buy for years, not managing to do it, whereas a proper investment, like it's just for the rent or the capital growth, it's so much easier to get in. So it also comes into place, okay, better to be in the market than to wait for the perfect home to live in.
And I would add, Srikar, that you may not know that, but 45% of people in Australia who are below 40 and who are buying property are rent investors. So they buy a property to invest, but not to live in. 45% of people below 40 who buy property. And this trend, which is called rent investing, is actually increasing in many, many countries around the globe. So actually, many people around the globe, either they cannot afford to buy where they live if they live in a big city, and or they just see as a better financial decision to invest in property rather than buying their home, right? So 45% in Australia. Arnav, will you share the data represented in these slides? Keen to see the suburbs which are not growing as per expectations. And sorry, Arnav, this is our IT. It's we work days and nights on this, so I cannot share this, Arnav. But I mean, if you want, as I was saying, if you want like more like high level data per state, yes, we can, but I just cannot share you these apologies. Oh, and I'm sorry. So it was gross rental yield. Oh, you responded, Pablo?
Yeah, well, I've been responding some of them, but at one point it was impossible to continue.
From Devi, is there a reason to consider 3 bedrooms for yield in earlier slides? So the reason why we did it, Devi, is that as per our data models, in some suburbs, it actually makes sense to buy a 3-bedroom house. In some, it's 1 or 2 bedroom units. In some, it's 4-bedroom houses. It depends. But today we bought 1 3-bedroom house in one suburb and 1 4-bedroom house in another suburb. Just because in our data we knew that a 3-bedroom in this price point here was the optimal strategy, whereas the 4-bedroom in this suburb made the most sense. Again, it's really a suburb, and to be honest, even like street specific. So yeah, so we just took an example of a 3-bedroom, but again, in areas where you invest, it may not be the best investment. All right. Booming. Okay, what are your fees? Yeah, so you already responded. Yeah, so so I think Pablo already responded. What is your basis of quantifying, measuring low expenses in the matrix? All right, so Anand, that's a very good question, and apologies that we ultra simplified this. So here, based on your experience with property, you can see if a house may require a lot of maintenance over time or not. If it's a very old house where things are broken everywhere, you can expect potentially like higher expenses than if it's in a newer, house in a newer area and where you've heard that the build was actually well done by the developers. Now, what I would recommend, Anand, is that for your next property investment, well, calculate your cash flows and well, check with local property managers what fees they are charging. Check with the seller's agents what the rates are for this property, and you can have like massive changes, by the way, right, from between one suburb and the other. So this will give you like quite certainty on the cost of managing the property and the cost of maintaining it. And then for renovation, etc. So this is very much like property specific. You should know when you define your strategy if you're looking for a property to renovate or a property that is kind of like set and forget, right? And this is your choice. You can find great properties in each scenario, but it's kind of like how we calculate it for our clients, right? So we actually calculate the cash flows, and we show the breakdown of cash flows, and we explain why we think cash flows, expenses may be high or low. All right. So from Suraj, what is the source of the data? So we use over 15 different data sources. The ones that you have seen today were sourced in the slide. Some were from CoreLogic, some were from Domain, SQM, Microburbs, and many others. So yeah, so like all the data and well, we actually like share our data sources with our clients. So yeah, it's accurate as per these data sources. All right, from Rahul. All right, so residential investment is considered, or actually maybe I could share my the questions. Why don't I share the questions that you can see, guys, what I'm...
I think everyone sees it.
You actually see it, okay.
Yeah.
All right, so let me expand the chat here. Residential, so from Rahul, residential investment is considered as one of the safest asset classes. You talked about some of the factors at the beginning of what makes Australia quite different from other countries. Considering the backdrop, would it be safe to say all properties will grow in the longer run? does your model helps us to find the growth areas in the short term, which helps in building portfolio quickly? All right. So very good question from Rahul. Residential investment considered as one of the safest asset classes. I would say be careful. Yes, Australia has had a very good run on average over the past decades. But as I was mentioning, I think earlier, I think it was a question from Vijay, we are seeing increasing volatility and we are seeing growing gaps between winners and losers. So to your question, will it be fair to say all properties will grow in the longer run? Honestly, no. And even in the past, it has not been the case, right? Many people who have bought property, and we know quite a few areas 10 years ago, lost money, right? So, no, like just be careful, Rahul. It wasn't true in the past, and with increased volatility today, it may be even less true in the future. So, so in our model, what we look, so we are actually not, when it comes to capital growth, we actually, so without going into too much details, we look at medium to long term, right? A short-term gain is only made by making a great deal. So buying below market price. And this, so we have like property scouts, so like local property experts who can help us find great deals. But short-term, you can only see as well buying below market price. And honestly, given the volatility, being a little bit lucky with the prices. What you want, and you know, like something really to consider is that given the acquisition cost, you know, so between stamp duty, conveyancing, etc., like be careful if you only want to do short-term investments, right? By doing short-term investments, you are actually relying a little bit more on luck for a given price increase in an area. And as all of you would have seen in the past 18 months, the market can shift quite drastically, right? So buying today, hoping to sell at a big profit in 12 months is risky, right? So that's not our mindset at PropHero, right? We look, our model looks for long-term capital gain, and finding the best suburbs in terms of long-term capital gains. All right. Can you get a demo of the machine learning and AI tools model usage? So sorry, this again, this is internal IP. From Arnav, is it better to chase capital gains or cash flow investments? Melbourne City of Albion seems to be having low prices compared to Sydney. Would you say it is an advantage? Okay, so awesome question, Arnav. Thank you for this one. So first, you will have to define your strategy and your personal needs. Are you in need, absolute need for positive cash flows or not? If you're in, I mean, if you cannot afford negative cash flows, I would say, well, then well, you may already have your answer. If you have the choice, though, then think about it. So we like to think about what is your risk level and what is the volatility in the scenario, what is the likelihood of each scenario. So remember that your total profit for an investment will be composed of your capital gains and your net rental income over time, right? Think about what is the likelihood that your net rental income will go up or down versus your business plan, and what is the likelihood of risk on capital gain. And what we see is that in many areas, your rental income stays relatively constant or slightly increases over time, right? However, there are big differences in capital gains, which means that if you only invest in for capital gains, then there is just like more I mean, there are more chances that it goes up or down than if you just look for rent, right? I can just can share one final thing with you. So we actually have like 3 types of investment at PropHero. So capital focus, yield focus, or hybrid. The vast majority of our clients go for hybrid, which is like a good mix of rental yield and capital growth. Now, not to say that it's the right approach for you or now, but yeah, so I would just say, yeah, be careful about your cash flows depending on your personal situation, and think about scenarios. If this happens to the Australian economy, how does this impact my overall profitability, right? And think that historically, rents stayed roughly constant on average, or slightly, or went slightly up, where prices actually had big moves, right? So that's just something to consider for you. All right, so many questions, guys. So, Nadi, I am thinking of investing in Perth, Brisbane, or Adelaide. Which city do you think will have better growth? So, just a city, Mali, actually is not exactly the right approach, because for a given city, you have massive differences between one suburb and the other, right? So I would say analyze specific markets. If you want to go by yourself, analyze specific markets and try to look at the suburb level at minimum, what you think the rule of 8 is going to look like. But again, you have like great areas in Perth, in Brisbane, in Adelaide, but just not in all. There is also one thing though, I mean, and I don't want to deter you from going in one area or the other. In some cities, property prices are quite highly correlated with raw prices, with prices of commodities. And I will just say this, check historical data, check how prices in these cities evolved with commodity prices. Now check what's the current level of commodity prices, and think for yourself if it's the right time to buy in this area. I'm actually sharing with you some other insights from our models, but yeah, like look at how the economy is split in your area that you want to invest in. Look at where jobs are, in which industries, and what is the risk of each industry, right? And when you invest in an area that is extremely dependent on one main industry, well, then be sure that this industry, or try to find confidence that the industry will go up in the future. By the way, we didn't discuss at all about this. It's like much more advanced, but yeah, just think about that. It's actually really important. Oh, very interesting one from Robin. Is it good investment in holiday letting properties? So I'll just expand your question, Robin, to short-term investments. And let me
Short-term rental.
Yeah, sorry, short-term rental investment. So beyond like holiday rental properties, so short-term rental. Some areas have amazing yields if you do short-term rentals. Amazing yields, 7, 8, 9, even above 10%. That's true. And by the way, I'm saying this because we track all this data, because for some of our clients, we also look for these investments, so we know this very, very well. I would just tell you, so a few things, Robin. Number one, COVID changed quite a lot the short-term rental market. And so the data you may see from 2 years ago may not be very relevant, or maybe it will become relevant again in 6 months or 12 months, but right now it can be very much misleading. Number two, regulation is changing in many areas. And very concretely, the number of days you can put a property on Airbnb is now regulated in many areas, which would impact these short-term rental yields. So is it good? Is it a good investment? I would say it depends, Robin. It depends a lot on the area. Some we are very confident in. and some we see it as highly risky, either because it's uncertain what's going to happen after COVID in terms of short-term rental, and number two, it's uncertain because of regulation. So just watch out for this. And then if you want to go like through like a holiday letting company, okay, just watch out. I would say, just like for off the plan, you have very honest and great people. You have less honest ones. So just be careful. Check the cash flows. Understand the risk that I've mentioned before you make this investment. I would say, yeah. So I mean, as a fact, we don't invest in holiday letting areas, but we do indeed invest in some short-term rental areas. We do indeed. All right. All right. So last question from Tanya. Thanks, Tanya, for this. So, do you foresee an intervention by regulators on investors? And what's been the impact from the past trends on the housing markets? All right. So, there is an expression that I learned when I was an investment banker in London, which is that there is not one single tree on earth that grows to the sky. I don't know if you say the same thing. Well, the crazy acceleration that we have seen, of course, will not last forever, right? That's obvious. And I think the question will be, will it slow down by itself, or will it need a push from the regulator? What we are seeing, okay, that's actually like a macroeconomic considerations. I think that there is one of the biggest questions that every country has on Earth right now is what will happen to inflation. And so every country, or most countries on Earth, increased their debts quite a lot. They financed the economy, so did Australia. And historically, economists thought that this would lead to a growth in inflation. And of course, the growth in inflation has a massive impact on your interest rates, and interest rates have a massive impact on property prices. And I'll be super honest with you, Tanya. I don't know, and I discussed this a lot with my friends in banking who are like economists, and they don't know either. What I can say that I am sure 100% is that the current acceleration is not sustainable. And will the slowdown become negative or just a slowdown? This I don't know. And will it be triggered by the regulators or by external factors? This I don't know. Now, many people say that prices became crazy in Australia. I'm still happy to share you one insight, Tanya. We looked at the ratio between property prices and GDP, or GDP per capita, in many countries around the globe. And though it is true that yes, prices are expensive in Sydney, even in Melbourne, actually when you compare it to GDP per capita, it's actually not that crazy compared to international benchmarks. So when I hear people say, yeah, it's crazy, it is obvious it will go down, I'm just saying that when you look at international benchmark, this has not happened in countries, in other countries where prices also went up, and even went up more than here. So just for you to say that the answer, Tanya, is very honestly, I don't know. And honestly, like economists that I talk to don't either. But what I am sure of is that the current acceleration is not sustainable, and I think everyone would understand this.
And the background, Tanya, as well, like it's about what's your thesis for investment? Are you planning to invest for the just next 2 years, as Michael mentioned before? Then yes, it would probably be like, would you get a bit more of the high, would it fall? But if you think about long term, even back in Europe in 2000 GFC, like it crashed, prices now are even higher. So in the long run,
yeah, Exactly. And for you, I think Tanya, like for you, actually one last insight. One last insight. In finance, diversification is not only about buying different assets, so like different houses for property. It's also buying at different points in time, right? And so diversification is not only per asset, but also in time. And so if you think about, if you believe in property, Tanya, and if you want property to help you build wealth and financial freedom in the long term, think that diversification, so that if you want to invest, no one knows when the markets will slow down. It may happen tomorrow or in 2 years. But by buying your different properties at different points in time, you actually hedge your timing risk, right? So over the next 10 or 20 years, you will have both during downs, you will have both during ups, right? But overall, your risk will be reduced. And it's all about, for you guys, what you have seen during this presentation today. Yes, maximizing your return, but also reducing your risk. And reducing your risk is done through these two levers.
Sorry guys, I think you're not, the sound is not very good. We're gonna switch to the sound in my laptop.
Okay, better now?
Yeah, I think so. I think it's slightly better.
Okay, perfect. Too bad that we just finished.
Yeah. Sorry for that.
All right. Guys, do you have any more questions? I know that there were like so many, but please feel free to write us if you have any more before we close.
Michael, can you hear me?
Yes.
Okay, I've got one question. Now, again, I know you guys have got your fees and everything and intellectual property, but do you share, or is it like a subscription that you can share? Okay, in the past, we have recommended 10 suburbs, I'm not talking property wise, but 10 suburbs. And this is what they have done in the past 5-10 years. You know, I'm not too sure if you've seen something like Barefoot Investor. I subscribed to his newsletter, like a yearly one. And he does that. Like he said, that's my 100K portfolio. This is what I purchased them at. These are the share prices at this time. This is what I recommend. Do you guys have anything of that sort of data that we can purchase or subscribe to on a yearly, monthly basis?
So actually, it's funny that you say that, Kapil. Actually, we are going to do this at some point next year. But you know, so I mean, the reality is that yes, I mean, we've had like a great performance in the past, but many didn't, right? So it's actually like more like comparing against benchmark, actually, that we did better than average. So yes, we will in probably next year, Kapil, not right now, because again, yeah, it's like really like the core of our IP. But yes, I think that we actually discussed this a lot. We will probably do it at some point next year. But of course, I mean, we will only show areas where we invested and where we don't invest anymore. Because by definition, if we are good at what we do, areas where we invest today, we will not invest in a few years because prices will have been up to
exactly. Yes, exactly. That's part. Yeah, exactly. That's past data. So you go. This is what we have done in the past. This is how it has performed. For somebody to go, okay, if we look at past 5 years, this is what they have recommended. It's gone up or down, and you kind of get more confidence in the data itself.
Absolutely right, Kapil. And so actually, well, we can absolutely, I mean, if you want to send us an email at info@prophero.com.au, we can also actually send you like sanitized property reports of property that we have bought in the past. So you won't see the address, you won't see the suburb, but you will see the performance that we are getting. Absolutely.
Okay, so what's that? info@prophero.com.au.
Yeah, I'll put it here in the chat.
Yeah.
Yep, cool. Thank you. Appreciate it.
Yeah, and Mala, so what our charges? So it's just a fixed fee, right? So $990 engagement fee to work together and $9,000 success fee. So when we buy your property, and compared to other players, so we don't charge a variable fee because our goal is to find you the best property. So it's not to find you the most expensive one. So yeah, so in total, so 1 plus 9,000 is our total fee. All right.
All good?
Any other questions, anyone? Okay, I think we're done. Thanks a lot, Michael. Thanks a lot, Pablo. I think
Thank
this
you.
was a great session. Everyone, gained a lot. Thanks for your insights, sharing your information. And yeah, again, guys, thanks for attending, everyone. And if we go forward on, Rohit, maybe just you can contact these guys offline and discuss that with them. That's okay. Yeah, as I was saying, we'll see you next time, guys. Thanks a lot for attending, and thanks, Michael and Pablo, once again. Cheers,
Thank
guys.
you. Have a great weekend, guys. Bye-bye.
Bye-bye.